Okay, guys, so let's do a Federal Reserve briefing. We've got a statement being delivered. It's just over 4 hours time now. Of course, it's only every other meeting that Yellen has a press conference, and the Fed raised rates start of December. Not start mid-December, I should say, 16th of December. The Fed raised rates, a landmark event. Is Yellen looking quite perplexed on my screenshot? We'll come back to Yellen in a sec, but just thinking about the actual interest rate hike. Here's the chart, here's the significance of it, because as you all know, it's the first hike since June 2006, and 7 years straight around zero. And so, whilst it's in the grand scheme of things, we're basically still at zero. We're close enough to be basically zero bound still, but the significance of the beginning of what Fed hope are going to be a tightening cycle. Of course, with the flare up in market anxiety, with the risk off, with the negative sentiment that's dominated 2016, the risk of the Fed making a policy error here is certainly substantially increased. We'll talk about what markets are hoping for in a second, but I think there's a lot of people out there in the marketplace who are hoping for a dovish angle to the Fed statement to give a bit of respite and relief to sentiment. But let's look. I mean, last time it was 6 weeks ago, and yes, we've had a very large amount of market volatility globally, but it's mostly about China and crude oil, of course, that's driven that. So let's have a look at what the Fed look at and just assess how data come in over the last 6 weeks. And look, I'm going to show you, well, let's show you this screenshot first. It's just looking at all the different types of data. This is quite a good graphic. We chopped off Twitter this morning. All your different sort of data related things. What you have here is the latest figure in the latest column compared to what this data was last time the Fed met, and then over all right hand side here you've got the result. Has that data development been bullish or bearish for the dollar? And you can see it's a sea of red down the right hand side here. So a lot of these data points have disappointed. Retail sales has come in at -0.1%. Core retail sales was very weak. Michigan sentiment has actually improved though, and consumer confidence, which was delivered yesterday, came in surprisingly resilient. And on the labour market stuff, and I'll show you the payroll numbers that chart in a minute, but payrolls were very, very strong indeed. But then on the inflation side, well, it's mixed, but year on year, I would say the core inflation was important. I'll show you that chart in a minute. Inflation was more mixed. Housing data you can see here was mixed as well. When you get down to the manufacturing and the services sector data, this is almost entirely disappointed. And this is one of the key concerns for economists and investors and traders. It's the PMIs, it's the manufacturing ISM figure remaining below 50. It looks like the ISM services number or non-manufacturing number is going to track down and converge dropping towards 50, and these lead indicators are causing concern about GDP expectations across 2016. And then when you add in the angle with the energy price situation and the continuation of the collapse that we've seen in energy and more broadly commodity markets in 2016, and this adds up to downward inflation expectations, and so it all adds up to what people hope is going to be a message from the Fed of reassurance. They raised rates in December. The key thing about their message in December, if we look at the Fed's dot plot, the thing I was most surprised about by the December meeting, they hiked. That was obviously fully priced in. It was actually what they did to the dot plot matrix on the front end, and what they did, they left the end of 2016 rate expectation unchanged at 1.325%. Now, to get to 1.325% by the end of this year, you're going to need 4 hikes, people. That's 4 hikes in 2016. If the Fed want to do this properly by spacing them out evenly and doing doing it as consistently and slowly as possible, then they're going to need to hike at the end of each quarter, which means, of course, they're not going to hike today, but it does mean they're going to hike next meeting in 6 weeks' time in March. If they want to try and achieve 4 hikes this year, they've really got to hike in March. Surely they can't deliver a statement tonight that still implies 4 hikes and still implies they're going to hike rates in 6 weeks. I mean, this is what markets, the behavioural side of markets, the fear of the risks has led a lot of market participants, to want to see some dovishness from the Fed tonight and just reassure us, please just tell us we're not going to hike in 6 weeks' time. We're already worried that hike number 1 was an error, and in fact, actually, when you're looking at some of the probabilities on some measures, there's a higher probability of a rate cut tonight than there is a rate hike. But obviously, Will's just saying, even a rate cut would be an error, and a rate hike would be an error. Rate cut would be an error because it would really be an admission that they've completely screwed up, that they've made a massive policy error, and just 6 weeks later they reverse it. Their credibility would be absolutely annihilated, and markets would collapse. That's if they cut rates. They're not going to do that. If they hike rates, you're going to get big reaction with lots of dollar strength. Of course, equities that are already vulnerable this year will come under more pressure, but they're not going to hike either. They're going to be unchanged. So it's more about what can we glean from the statement with regards to have they changed their outlook for this year? Are they going to hike in March or not? Let's look at quickly a couple of other charts here. This is core inflation. This needs to be factored in because don't think for 1 second the Fed are just going to cave as a result of a couple of weeks worth of financial market volatility. The Fed aren't just going to suddenly flip-flop Gartman style and turn around and give a completely opposite message. They're going to look through a lot of this volatility. I think they're going to come back today and be dovish, or not as dovish as people want. I think they're going to have to maintain their view, and that is that we're data dependent. Every meeting's live, implying they could hike in March. I don't think they will hike in March, but it's important for them to keep the door open to maintain their credibility. I'll talk about a specific sentence in a minute, but when we get to the detail of the last statement. But just very quickly, look, very strong on inflation, core inflation above 2%. Non-farm payrolls, this has been very, very strong. Quarter 4 2015, easily the best quarter of the year. Okay, labour market conditions are strong apart from this one, which is still stubbornly weak, and that average hourly earnings, wage growth still not there. 0% print at the beginning of this month. Okay, that's the one outlier here on the labour market. But core inflation says the Fed were right to hike, and it will be a hiking cycle. Non-farm payroll says also that we're going to be seeing the hiking cycle unfold this year. With regards to the Amplified poll, those that joined, thank you. We only got 37 votes. We've got to pick this up, guys, for next time. The sample size here is low. But as you can see, the Amplified opinion poll shows that a dovish reaction will be most likely 41%, neutral 35%, hawkish is the lowest at 24%, but you can see a little tick there, and that's because that's me. So I have voted for a hawkish market reaction. I don't think you're going to get a massive reaction tonight, but I do think I'm neutral to hawkish in terms of how markets will respond, and that's because I don't think the Fed will quite give markets enough reassurance. I don't think they'll deliver quite as dovish a message that markets want. Let's look at the Fed statement, because this is it. You can get this stuff on the Fed's website. You can get the statement and the minutes and the dot plot. So, do get onto these websites before these events, the federalreserve.gov here. This is the full statement from the meeting on the 16th of December when they hiked rates. A couple of things to point out. What we're going to be doing is sifting through the statement that's going to be announced tonight, checking what's changed. there's some interesting comments in here, stuff like market-based measures of inflation compensation remain low. Some survey-based measures of long-term inflation expectations have edged down. This is almost certainly going to remain in there because ultimately the commodity markets have cycled lower again, and it's really, again, surely delayed this return to inflationary world. Lots of other comments in here. I'm just looking at overall, taking into account domestic and international developments. Keep an eye out for international developments. Of course, that means China risk, basically. The committee sees the risk of the outlook for both economic activity and labour markets as balanced. Now, last month in December, they removed a word here. It's not there anymore. It was nearly balanced. They took out nearly and said it's balanced, i.e. we've ticked our box, which is the mandate of maximum employment, so let's hike rates. They say inflation is expected to rise to 2%. Over the medium term, they're obviously talking about the transitory effects of energy, etc., etc. They said last time that there's a considerable improvement in the labour market conditions this year, and that they're reasonably confident inflation will rise. All this stuff is important. Just scrolling down, last one to point out. The committee, where is it? The committee expects economic conditions will evolve in a manner that will warrant only gradual increase in the federal funds rate. Federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. Blah, blah, blah. Now, we're not going to get an update on a dot plot. It only happens once a quarter, once every other meeting. That's the meeting with the press conference. What will happen today is, and that goes for GDP and inflation forecasts as well, what we'll get is just a statement delivered at 7 p.m. All it'll be is a big series of headlines that flash onto Bloomberg all in one batch. And these headlines will be, some of them will be hawkish, some of them will be dovish, some of them will be bullish, some of them will be bearish. You're going to get a mixed bag, and it's always a tricky one to navigate through. But all I'm going to try and do is use qualitative messages to try and tweak our expectations. Let's have a look at some of these markets. Let's just look on daily charts first. Let me just change a few of these. Let's just look at equities. Let's look at the dollar. Let's look at crude oil here on the bottom right. Equities, you know the story. Massive sell-off, bounce off the 1800 handle. We failed at 1900 on the S&P, and now we're just sat pleased. What markets want is some dovishness tonight. They want the Fed to ramp up their rhetoric on international developments. There's a sentence they used in September's meeting. Now, in September, everyone thought we were going to hike rates, but they didn't. And they used a sentence to really raise or to introduce something new, which was international risk. What they said was, recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. That's the sentence they used. They only used it once. Following the meeting, it disappeared. And it wasn't in the December meeting either. I think if you really want a dovish message today, that sentence will be reintroduced to the statement. Let me repeat it. Recent global, so the important word global, you can basically remove that and put China. Recent China economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. If that sentence is back in the statement, that will be taken dovishly. If we get a dovish move, then obviously you get dollar weakness, which will send the euro dollar almost certainly above the 110 handle. Let's get this euro dollar chart higher. Any dovishness here, and we're going through 110, we're going to test 111. This is the December high. We may well get up through that as well. So dovishness will be the Fed really putting the chances of a March hike to bed, being dovish and pointing towards international risk. Now, how equities respond to that, I'd be very careful, because in September last year, the S&P rallied off the back of that dovishness. They didn't hike, dovish, and immediately the S&P rallied, but by the end of session, the S&P had collapsed. Big sell-off, big new lows into the close. And that's because ultimately, the Fed lost a bit of credibility. Ultimately, actually, markets were surprised that the Fed paid so much attention to the international risk, and therefore markets said, well, actually, maybe those risks are larger than we thought. And so in the end, you got a negative reaction. Be careful with equities here. If you get dovish in the statement, you may well get short-term upside, but it might not be sustained, and you may well get the opposite by the time we get to the close. I think the dollar movement's going to be more straightforward. You know, if they keep the statement unchanged, it's going to be hawkish, and you're going to get dollar strength. And of course, here you're going to get the euro dollar trading down to test the low of January, or 21st of January low on the 108 handle, and of course, actually the low of the year set back at the start of the year at 107.29. So we've been trapped on euro dollar really ever since Draghi disappointed us back on the 3rd of December. We could potentially get a break in this range tonight. Probably not, though. I actually think the Fed aren't going to change too much. They might just very subtly introduce a touch of dovishness just to say, look, it's not going to be March. It's probably going to be more like April. And just as I say that, let me just bring up a chart for you to finish off the briefing here, because we've got Department of Energy numbers in 5 minutes, so I need to get off the mic, but I can't get off the mic until I've shown you the expectations, what are current Fed funds futures pricing in with regards to rate hikes. Here is the final chart before I talk about oil. We've now got the situation where the probabilities, according to Fed funds futures, is that we're not going to get a rate hike till September. Hike number 2 is not coming until September. Forget March, forget June, forget 4 hikes this year, so it'll be 2.